You finally get that raise you've been waiting for. You open your banking app expecting to feel lighter, and somehow your life still feels exactly as expensive as it did before. Your rent or mortgage is up, your groceries look like they've been price tagged by a prankster, and even your treat yourself coffee now feels like a small financial decision, which is confusing because you did everything you were told to do. You worked, you earned more, you kept your spending mostly sensible, and yet the system keeps siphoning off more than you can see. That feeling has a name, and it's basically the UK's secret wealth tax, because it isn't a single line on your tax return that says wealth tax, but it still behaves like one. It quietly shrinks what you can keep, and it does it through a bunch of taxes and rules that don't sound scary until you add them together. My name is Hector, and I write about personal finance systems and the little rules that decide who gets ahead. Here's the problem, and it matters whether you're on 35K or 350K, because the biggest money leaks are rarely the ones you notice. Most people look for the obvious villain, like income tax or national insurance, and while those definitely hurt, the real damage often comes from stealth taxes and by-the-way charges that hit you when you try to build a life. They cost you thousands over the years, not because you did something wrong, but because you didn't realize the game was being played in the background. So stay with me until the end, because once you see where the secret wealth tax hides, you can stop donating extra money to it by accident, and you can start using the same basic defenses that people with accountants already use. The first trick is that the UK doesn't need a formal wealth tax to tax wealth, because it can tax the moments when wealth moves. When you earn, when you spend, when you buy property, when you sell an asset, when you pass money to family, and even when inflation pushes your pay into higher tax bands, the state takes a cut at each step. If you only look at one step at a time, it feels manageable, but when you stack the steps, it starts to look like your wealth is being taxed for the crime of existing. And the most secret part is that a lot of it happens without Parliament announcing a dramatic new tax, because thresholds and allowances can be frozen while prices and salaries rise. That sounds boring, but it's brutal in practice, because it turns inflation into a tax collector. This is the part that gets almost everyone, including people who don't think of themselves as wealthy at all. If tax bands and allowances stay the same while your pay inches up just to keep up with costs, you can end up paying a higher effective rate even though you're not meaningfully richer. Your lifestyle doesn't upgrade. Your savings rate doesn't improve, but your tax bill grows anyway, which means the system has extracted more of your earning power without changing the headline rates. You've probably felt this when a small raise didn't feel like a win, because it just pushed you into a worse zone where you lose more to deductions, or you lose eligibility for something you didn't even realize had an income cliff. It's like walking up an escalator that's moving down. And the reason you're tired is not because you're lazy, but because the escalator is fighting you. If you want more videos that translate boring policy into real-life money decisions, subscribe. Because this is the kind of stuff that quietly decides whether you feel stuck or finally start moving forward. Now let's talk about the most obvious wealth moment in the UK, which is property, because nothing reveals a hidden tax system like trying to buy a home. The minute you go on Rightmove and start daydreaming about a second bedroom, you enter a maze of costs that are basically taxes wearing different outfits. You pay stamp duty when you buy, you pay council tax while you live there, and if you're a landlord, you may pay extra layers through rules that changed how mortgage interest and profits are treated. Even if you're not a landlord, the system still taxes your ability to move, because transaction taxes make it expensive to relocate for work, to downsize, or to adjust your life when your circumstances change. Council tax is a weird one because it feels like a bill rather than a tax on wealth, but it behaves like a tax tied to your housing value in your local area. It also doesn't always feel fair, because bands are based on historic valuations, and that means two similar households can pay surprisingly different amounts, depending on where they are and how their property is classified. If you've never checked your band and compared it to your neighbors, you might be overpaying for years without realizing it, which is the definition of stealth. Then there's the part nobody likes to talk about, which is that housing is where many UK families store most of their wealth. That means even if you don't feel wealthy, the moment your home value rises on paper, you start attracting more attention from taxes that hit when the asset changes hands, whether that's through selling, buying again, or leaving it to someone later. The state doesn't need to tax the value every year because it can tax the life events around it, and those events are exactly when you're least able to say no. Next comes investing. And this is where the secret wealth tax can either punish you or completely miss you, depending on whether you use the simple wrappers the system already offers. Outside of wrappers, you can face capital gains tax when you sell investments at a profit, and you can face dividend tax when investments pay out income, and you can face tax on interest from cash savings once you're beyond the easy allowances. The sneaky part is that the tax often arrives at the moment you're doing the responsible thing, like rebalancing a portfolio, cashing out to buy a home, or switching providers, which means good financial behavior can accidentally trigger a bigger bill. Inside wrappers, the story changes dramatically, and this is where a lot of people accidentally pay the secret wealth tax simply because they never set the wrapper up. ISAs are the cleanest example because they create a legal bubble where gains and income can grow without the same tax friction. Pensions are another bubble because they often give you tax relief going in, and they can grow efficiently while invested, even though withdrawals are a separate conversation later. You don't have to be rich to use these, and that's the point, because the real difference between wealthy and not wealthy is often just whether you've built these boring protective walls. If this is already making you think, wait, so I've been doing this the hard way, hit like, because the algorithm tends to hide practical finance videos behind drama, and I'd rather you get useful information than another hot take. Now we get to inheritance, which is where the UK's hidden wealth taxes become painfully visible, usually at the worst possible time. Inheritance tax is basically a tax on transferring wealth after death, and while there are allowances and reliefs, the simplest version is that estates above certain thresholds can lose a large slice to HMRC. The part that feels secret is not that it exists, because people have heard of it, but that normal families get caught by it when property values rise and thresholds don't keep up. A family home in the Southeast can turn a completely ordinary household into an estate on paper, even if nobody involved ever felt rich. This is where planning matters, not in a dodgy loophole way, but in a don't stumble into avoidable taxes way. Gifts made early enough can fall outside the estate, and using the available allowances over time can matter more than any fancy strategy, because it's consistent, boring behavior that reduces future tax friction. Even simple things like having paperwork in order, knowing what assets exist, and understanding how pensions can sit outside the estate, in many cases can change the outcome. Because chaos is expensive and clarity is cheap. Finally, there's the broadest and most invisible piece of the whole secret wealth tax, which is consumption taxes, fees, and inflation itself. VAT hits you when you spend, and it hits hardest when most of your income goes to essentials because you can't opt out of groceries, transport, and basic services. Fees are their own universe because a 1% fee on investments sounds small until it quietly eats a massive chunk of long-term growth. Inflation is the ultimate stealth tax when your cash sits still because it loses buying power while the world gets more expensive, and you pay that cost without receiving a bill. So what do you actually do with all of this, without turning your life into an accounting project? You start by getting your income and your savings into the right containers, because the UK basically rewards you for using ISAs and pensions the way they were designed. You check your property-related costs, like council tax banding, because mistakes persist until you challenge them. You think about wealth moments before they happen, like selling investments, buying property, or making large gifts, because timing and structure often matter more than the decision itself. You keep fees low and simple, because the silent compounding of fees is just another private wealth tax that goes to someone else, and you treat thresholds like they're moving, because in real terms, they often are, even when the numbers on paper are frozen. If you want a quick way to apply this without overthinking it, I made a free one-page checklist called the UK Stealth Tax Shield, and it walks you through the 5 places people leak money most often, including the exact wrapper choices and the quick checks that usually take less than an hour. The point isn't to turn you into a tax expert, because the point is to stop paying extra just because nobody explained the map, and you can grab it through the link in the description while it's still free.